Welcome to Tech Money Madness, your daily U.S. stock market podcast, July 17th, 2026.
It is quite a day to be looking at the markets, that's for sure.
It really is. I mean, we've got the S&P kind of just hovering, the Dow is dragging its feet, but the NASDAQ is surging.
Yeah, the indices are totally split.
Exactly. So welcome to today's deep dive. We are cracking open the daily market briefing, and honestly, the data inside is pulling in like three completely different directions at once.
At least three. It's a very confusing stack of sources today.
It is, because we've got bizarre inflation metrics that seem to just defy logic.
Right.
Plus, a labor market that is shrinking rapidly, while at the exact same time, people are out spending heavily at bars and restaurants.
Yeah, that paradox is huge.
And then on top of all that, we have surprising moves by legendary value investors pouring billions into AI infrastructure.
Which is a massive shift in market psychology.
It totally is. So our mission today is to decode these mixed signals for you, the listener. We want to figure out where the real opportunities and the real risks are hiding in a market that just, well, it doesn't seem to make sense on paper.
No, it doesn't. And when macroeconomic data contradicts itself this aggressively, you really have to stop looking at the headline numbers.
Right. You have to dig deeper.
Exactly. You have to start looking at the friction between the numbers.
Right.
Because the tension is usually where the actual story is happening.
Yeah, that makes sense.
And right now, the physical economy and the financial economy are basically telling two completely different tales.
Okay, well, let's jump straight into that friction with the macro weather report.
Let's do it.
The inflation data in this briefing is just fascinating because of the crazy push and pull.
Oh, absolutely.
On one side, import prices just posted this surprise gain. We're looking at the highest level since 2008.
Yeah, 2008, that's not a typo.
Right. And the sources explicitly tie this surge to the increased cost of goods coming out of China.
They do.
And they link that directly to China's overall economic slowdown. Now, I have to pause here.
Okay, what's catching you?
Okay, let's unpack this, because that feels really counterintuitive.
How so?
Well, usually if an economy slows down, demand drops, right? And if demand drops, prices are supposed to fall.
That's the textbook theory, yeah.
So why is a slowdown in China making the stuff we import from them more expensive?
Well, what's fascinating here is that you're assuming the price is being driven entirely by consumer demand.
Right, which is what we're always taught.
Exactly. But you have to look at the mechanics of manufacturing, the actual export logistics.
Okay.
When a massive manufacturing hub like China experiences a broad economic slowdown, factories stop running at peak efficiency.
Because they don't have as many orders to fill.
Right. They scale back production. But the thing is, the fixed costs of operating those massive industrial centers, the real estate, the baseline energy, the administration, those don't just disappear.
Ah, so they still have to pay the rent and keep the lights on.
Exactly. So those fixed costs are suddenly spread across far fewer units of output.
I see.
Plus, when fewer goods are moving, the supply chains themselves become a lot less efficient. Shipping containers might sit half empty, or they take longer to route.
Right, because there's just less volume moving through the system.
Exactly. And all of that structural inefficiency gets baked right into the final price of the product.
Before it even gets put on a boat to the U.S.
Exactly.
Wow. So we're essentially importing their economic friction.
That's a great way to put it.
The inefficiency literally becomes an added cost that gets passed directly to you, the consumer, at the checkout counter.
Yep. You pay for their empty factory space.
But here is the counter signal that makes this all so confusing today.
The domestic side.
Yeah. While we're absorbing those higher import costs, domestic wholesale prices actually declined by 0.3% in June.
Right. And if you isolate the variables in the briefing, that unexpected drop in domestic wholesale prices was driven almost entirely by one specific thing.
Falling gasoline prices, right?
Exactly. And the sources attribute that drop at the pump directly to a brief pause in U.S.-Iran tensions.
It's just, it's wild. It feels like the economy is driving with one foot slamming the gas on imported goods and the other foot gently tapping the brake on domestic wholesale energy.
Yeah, it's total whiplash.
And it even impacted the consumer side, right? Annual consumer prices rose 3.5% in June.
Right, which the analysts noted was actually less than expected.
Right, primarily because those easing energy prices just dragged the overall average down. But how should an everyday investor process this kind of geopolitical whiplash?
It's tough.
You've got China's factories and Iran's diplomatic relations directly impacting their wallet.
Well, what this data really proves is that your local purchasing power is entirely beholden to global volatility now.
Right. It's all connected.
Yeah, I mean, a lot of domestic policy discussions treat the U.S. economy like this closed loop.
Like the Fed is the only thing that matters.
Exactly. Assuming decisions made by the Federal Reserve are the only levers that control inflation. But this briefing paints a very different picture.
It really does.
A slight diplomatic shift in the Middle East directly lowers the cost of the fuel you put in your car.
While an industrial slowdown in Asia raises the cost of the goods you buy when you drive that car to the store.
Precisely. It leaves the consumer under a very specific kind of pressure.
Because energy prices are so volatile, right?
Yes, a drop in gas prices provides temporary relief, but it's not a structural fix. The rising cost of imported goods, however, tends to be much stickier.
Sticky inflation.
Right. Once supply chains restructure and prices go up at the retail level, they rarely come back down to their old baselines.
So the real risk here is that the temporary relief at the gas pump is just masking the long-term erosion of our purchasing power.
Exactly. It's masking those sticky import prices.
Which brings us perfectly to how people are actually responding to this pressure in their daily lives.
Right, the human element.
Yeah, because this economic stress isn't just showing up in shipping containers and gas pumps. It's dramatically altering human behavior in the workforce.
Oh, absolutely.
Let's dig into the labor market data in this briefing because it presents a massive paradox.
The labor data in this stack is honestly the perfect example of why surface-level metrics can be incredibly deceptive.
Right, because the sources highlight a huge contradiction here. On one hand, we're seeing that the World Cup has given a much-needed boost to bars and restaurants.
Huge spending happening there.
Consumers are packing these venues. They are still willing to spend heavily on experiences. But simultaneously, the labor force participation rate has plummeted to a 50-year low.
Right, excluding the COVID-era anomalies, of course.
Right. But at the exact same time, the official unemployment rate has actually dropped.
Yeah, and that's where people get confused.
So walk us through the math here. Because on the surface, a dropping unemployment rate sounds like a thriving economy. How can unemployment fall while workforce participation hits a half-century low?
It all comes down to how the official unemployment metric is calculated.
Okay.
Specifically, it's the relationship between the numerator and the denominator.
Right. The official unemployment rate only measures people who do not have a job and who are actively looking for one.
Exactly. If you don't have a job but you just stop looking, you're no longer considered unemployed by that specific metric.
You just vanish from the calculation.
You do. You are removed from the labor force entirely. So the denominator shrinks.
Which makes the ratio look better, even though the reality is worse.
Right. The sources explicitly state that the drop in the unemployment rate we're seeing right now is happening for all the wrong reasons.
It's not because millions of people are suddenly getting hired.
No, not at all. It's because job seekers are just becoming structurally discouraged.
They're hitting a wall.
Yeah. They're giving up on the job search and walking away from the labor market completely.
Okay, but I have to ask a pointed question here. I want to push back a little on this idea of a deteriorating reality.
Go for it.
If people are just giving up and leaving the workforce at historic rates, how are they funding this massive World Cup spending spree at bars and restaurants?
That is the million-dollar question.
Right. I mean, are we looking at a looming cliff for consumer spending? Are people just maxing out credit cards to watch soccer while they're jobless?
Well, you're hitting on the core vulnerability of the economy right now. First off, we're likely seeing a deep bifurcation.
Meaning a split.
Exactly. The individuals packing the sports bars and spending on premium experiences might not be the same individuals who are dropping out of the labor force.
So the economy is splitting between those insulated from the shifts and those being crushed by them.
Yes. And beyond that, temporary boosts, like a global sporting event like the World Cup, they can act as an economic smokescreen.
So they mask the underlying issues.
Completely. They mask deep underlying structural challenges. A month of incredible restaurant sales driven by soccer fans doesn't negate the fact that a historically massive percentage of the population has basically abandoned the labor market.
Right. And eventually that structural weakness has to catch up to consumer spending, right?
It has to, because you simply cannot build a sustainable, growing economy on a shrinking pool of human labor.
Wow. And if human labor is facing these incredible headwinds, investors are naturally going to flock to companies that don't rely on traditional labor models.
That's exactly what's happening. When human capital becomes unreliable, financial capital seeks out efficiency elsewhere.
Which tees up our next section perfectly. This leads us directly to the corporate strategy side of things, specifically big tech and the Magnificent Seven.
Right, the companies that don't need massive human headcounts to scale their profits.
Exactly. So let's shift focus to the corporate level. The sources note that the Magnificent Seven, which includes Amazon, Alphabet, and Meta, are currently trading at their lowest relative valuations in a decade.
Which is a huge signal for investors.
And today's most active stocks totally align with this: Apple, Amazon, and Meta.
Yep.
But I want to do a deep dive on Apple right now, ticker AAPL, because the numbers here are truly staggering.
They are eye-watering.
Since 2012, Apple has committed a jaw-dropping $851 billion to share buybacks.
Just think about the scale of that number.
$851 billion. Over 13 years, they have reduced their outstanding shares by over 40%.
Why?
And by doing that, they have boosted their diluted earnings per share, their EPS, by 373%.
Yeah, that 373% number is the one to pay attention to.
Okay, let's break down diluted EPS for a second, because that makes it even wilder.
It does, yeah, because diluted earnings per share is a much stricter metric than just basic EPS.
Right, basic EPS is just profit divided by current shares.
Exactly. But diluted EPS forces the company to account for all the potential shares that could exist.
Like stock options given to executives.
Yes, or convertible bonds. It's basically corporate inflation. Every time new options are issued, it dilutes the value for the public shareholders.
Right. So to boost that diluted number by 373%.
It means their buyback program was so aggressive, it not only ate up all that natural dilution from employee stock options, but still slashed the total share count by 40% on top of it.
That is insane. I like to use an analogy to explain buybacks to people.
Let's hear it.
It's like they took a large pizza, right? And instead of trying to bake a bigger pizza every year to feed more people, they just kept cutting the same pizza into fewer and fewer slices.
Right. They buy out the other people at the table and kick them out.
Exactly. So the investors left sitting at the table get this massive, decadent slice.
Great analogy.
But I have to ask, is a 373% EPS boost generated this way actual genuine growth? Or is this just brilliant financial engineering masking a lack of new innovation?
Well, if we connect this to the bigger picture, from a pure innovation standpoint, you're right. A buyback does not invent a new iPhone.
It doesn't create a new revenue stream.
Exactly. Yeah. However, from an investor's perspective, this financial engineering is just as potent as organic growth. Yeah. If you hold a share of Apple, your claim on the company's future cash flows has grown exponentially, simply because there are fewer competing claims out there.
Right.
So even in a sluggish macroeconomy, with sticky inflation and a shrinking labor force, these companies generate enough free cash flow to just mathematically manufacture growth.
They just use their own balance sheets to engineer it.
Exactly. It's a fascinating potential buying opportunity for listeners, honestly.
But here's where it gets really interesting. Because while Apple is spending hundreds of billions basically buying back its past, other giants are spending billions on the future.
Yes, the AI infrastructure race.
Let's list today's market movers to set the stage for this. The top gainers today are all AI-focused.
Unsurprisingly.
NVDA, Microsoft, and Alphabet. Meanwhile, the top losers are Elon Musk's ventures, SpaceX, and Tesla.
The market is making a very clear choice right now.
It is, but the most surprising nugget from the sources is about Warren Buffett.
Yeah, this caught a lot of people off guard.
Because Buffett is the ultimate value investor, he usually hates businesses that require constant, massive cash injections just to stay competitive.
Right. He likes businesses that fund themselves.
Yet he is expressing profound optimism toward Alphabet right now. And this is despite the massive capital expenditures, the CapEx that Alphabet requires to build out its AI infrastructure.
They're spending billions on data centers and chips.
Exactly. So why is Buffett making this bet?
Well, the sources break down why. It's because Alphabet boasts incredibly strong returns on capital, and they have a highly diverse business portfolio that can subsidize those massive AI costs.
Ah, so their search business and YouTube pay for the AI server.
Exactly. They generate a torrential amount of free cash flow. They can fund the future without having to borrow heavily at high interest rates.
Okay, but does his blessing mean something bigger? I mean, does this mean AI infrastructure is no longer seen as a risky venture capital bet, but rather a guaranteed utility, like railroads or power companies?
That's exactly what it means. The technology sector, specifically NVIDIA, Microsoft, and Alphabet, is officially the undisputed driver of broader market trends.
Wow.
Investors should view AI not just as a trend, but as the foundational infrastructure of the next decade's economy. They are laying the digital railroad tracks of the 21st century.
So, what does this all mean for you, the listener? We've covered a lot of ground today.
We really have.
And it seems like the U.S. market today is basically a tale of two economies.
Yes, very clearly divided.
On one side, you have a struggling traditional labor market weighed down by inflation, geopolitics, and people just dropping out of the
It's a
workforce.
physical economy.
Right. And on the other side, you have a skyrocketing tech sector fueled by AI build-outs and massive share buybacks.
But there is one final thought we should leave the listeners with today. Something the briefing implies but doesn't state outright.
Okay, lay it on us.
We just discussed how the human labor force participation rate is at a 50-year low because people are essentially giving up, and simultaneously, billions of dollars are being poured into AI infrastructure by companies like Alphabet and Microsoft. Systems designed to automate complex tasks.
Oh, wow, the timing of that.
Exactly. Are we witnessing the exact historical moment where capital permanently shifts away from funding human labor and directly into funding artificial intelligence?
That is a chilling thought.
And if so, what'd that mean for the future of the everyday consumer? If capital isn't flowing to human wages, how do those consumers participate in the economy?
I mean, how do they afford the things that AI is building?
It's the biggest question out there right now.
That is definitely something for everyone to mull over. Well, thank you for joining this deep dive. Keep questioning the data and stay curious until our next deep dive. That's all for today's episode of Tech Money Madness. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage.